Hey everyone, this is Joel.
And Noah from the Wealth is Health podcast.
This podcast is a conversation of our journey to financial health.
We think working till 65 just ain't it, and just like you, we're trying to make sure that never happens.
And if you're interested in letting us know what you're trying to do to achieve financial health and want to join us in our journeys, join the discussion on our Facebook at the Wealth is Health podcast.
Let's tap in.
What is going on, everyone? Welcome back to the Wealth is Health podcast. Joel and Noah back here again. And today we have some great stuff planned for you today. But before we get started, we're going to go into a little thing we want to call updates, where we kind of talk to you what we've been working on in the past week, where we're going, and then kind of our goals for next week.
Yes, sir.
I'm gonna give it off to you, Noah, so you can start.
You want to let me set it off? Okay.
Yeah, just because I talked a little bit.
All right, let's go. So, essentially, I'm in the process of acquiring a house hack right now. So we talked about it, I think, in the first episode, but basically that's just trying to hack your housing expense. So the way that I'm personally doing it is I'm buying a 3-family house, or a triplex is what it's also called. But yeah, so I'm going to be living in one unit and renting out the other 2. I'm probably also going to rent out bedrooms in my unit, because my unit, well, all the units actually in this property are 3-bed, 1-bath. So I'm going to have 2 extra bedrooms. So yeah, in order to get more cash flow, I'm probably going to rent out those rooms. But I just had the second inspection for this property. And by the way, you have a limited time frame for you to actually be able to inspect the property and figure out is this the move? Is this what I'm trying to do or not? So I went there for the second time. I couldn't get into the first floor unit the first time we went. Joel was there for that.
That's crazy.
Yup. And the first floor was big capping, bro. We could not get in, and they had the nerve to tell the seller that that we got in. So I don't know why they was lying, we wasn't gonna check up on that after the fact. But yeah, so the seller ended up paying for the inspection of the first floor unit. And mind you, they had already said that basically they weren't trying to let it, the first floor people weren't trying to let us in because they flooded that hoe out, with the leak. So that's what they were trying to hide. And they also said at first that there was so much damage that they were going to, rip the unit down to, the studs, and I was going to be able to completely redesign the whole thing myself, which was also cap. So getting used to that during this journey. Nothing is ever going to go how people are saying it's going to go. And also, if you don't have anything in writing, then it's just not. I
was about to say, because I'm not gonna mention his name, but the dude you're working with, he said everything was not on paper, or he just was saying stuff to you, and I was consistently thinking I wonder if this stuff is gonna be on paper. And then what you said in the chat today, with how you talking about this, oh, they'll probably sign it. What?
Yeah, and that's why I literally told him. I literally told him in that text after. I think I sent it to y'all too, where I was like, bro, I do not play with my bread like that. And if it's not in writing, then it's a no-go. That's just what it is. So essentially, I saw the property on Tuesday. I went in there. Mind you, they were still mad leaks. They didn't do anything that they said that they were going to do for the most part. After they had cleared up that they're not going to have to tear the unit down to the studs or whatever, they're like, all right, so we're going to retile the kitchen and the bathroom, and we're going to paint all the walls. They did not paint not one wall, not one of them. So as soon as I get in, I'm going to have to paint all of the walls. They may have redone the flooring in the kitchen, but I know that they didn't do anything in the bathroom because I know exactly what the tile looked like before, because the other units looked exactly the same, and I saw those.
So is it not a big deal to you that they just lied to you about the walls? Shouldn't you kind of fight that and say, you said you're going to do the walls, or is it because your time's expired right now, you just want to get it over with? It's not that big of a deal.
Yeah, it's not really the biggest deal, just to get the walls done and all that. I didn't have it in writing, so they don't really have to hold me to that. Or I don't have to I can't hold them to that anyway.
But whose job is it in charge to put it in writing?
That's between the realtors.
Okay.
Yeah.
So your man basically
but they were
failed
still,
on you then.
I don't know, because I feel it's kind of on both sides in a way. Because I don't think that the other realtor should have been telling him this stuff without it being confirmed first. Because I think they might just be cool, so they're just going back and forth telling each other as the updates are happening in real time, and instead of waiting until this is finally confirmed, we know the exact move we're gonna make, and then communicating that. I think that's what it really is, to be honest. But yeah, so I go in there. they may have redone the flooring in the kitchen, but I mean, it wasn't really up to my standard. It's okay. Like, I don't have to redo it, but if I was doing it, I would have done it better. I would have designed it better, picked like better materials is what I'm really saying. But yeah, I go in there, like the shower head was leaking, the faucet for like the tub or whatever, that thing was leaking. The inspector said that there was like something weird on the ceiling, and they were like, "Oh yeah, because there's a leak from the second floor coming down here too." I go to the kitchen sink. I'm like, "Oh, so this is leaking." I open a little cabinet door. I'm like, "Oh, Drake's album leaked." Walk down the hall. I'm like, "Oh wait, our episode 3 leaked." Like, just leaks everywhere. So I'm trying to have them fix that right now. And kind of the frustrations that I was going through today actually was my inspection period technically ends today, and my realtor has sent me an extension form last night, like asking the sellers to extend it to next week. And yeah, so I had signed it last night after he sent it, and then I was checking up with him today because it ends today. So I'm like, yo, so did they sign it? Because I know I signed it, but if they don't sign it, then we're not like in agreement on that. But he was kind of like, oh, well, I mean, I wouldn't really stress about it. Like, he was on that too.
They'll probably sign it.
Yeah, like, he literally said, like, oh, they'll probably sign it. Like, don't get nervous.
That's what he said.
Like, yeah, but I'm like, family, no. Like, this is my bread we're talking about. Like, this property is hundreds of thousands of dollars that is, like, hitting my balance sheet with debt attached to it. Like, a lot. So, yeah, like, I need this in writing, family. So I had to communicate that today, and he finally got back to me a little while ago and said that they officially signed it, but it actually expires Tuesday instead of Friday like we requested. But we'll see how that goes. Hopefully I'll be able to actually get in there and check to see that the work was done, because they told me, this is another point actually. I didn't even want this to go too long, but this is very important. Yeah, so the sellers had told my realtor, who told me that they already fixed the leaks. And he's like, yeah, they said they already fixed it. Like, they're going to send us the pictures soon. I'm like, all right, bet. A couple days had passed. I'm like, yo, it's like, what's good with these pictures? And he's like, oh, well, they don't know when they're going to be able to send them yet or whatever. And then when he texted me today saying that they signed it, he was like, oh, yeah, by the way, they said that they actually didn't fix all that stuff yet, but it's going to be fixed by when my inspection period ends, which is Tuesday. So I'm like, all right, so y'all are just capping all around. But
that's why I don't like. I'd be sketched out working with some of these people because it just feels like something shifty's going on. Like, why is it like that? It's like they act like you can't go in that property and see what's actually going on. Like, I feel like that's how they're acting. And now they're saying, I mean, I hope that second floor tenant does move out because they were trash. But
yeah, we didn't even mention that too. By the way, but I'll just say it real quick. So essentially, they need to have one unit vacant by closing, because I'm using like an FHA loan, which lets me get in there for only putting 3.5% down for my down payment. But you need to be living in the property for like at least a year, so you have to be able to kind of get in or prove that you're gonna move in within like 60 days after closing or something like that. But yeah, so like I was gonna take the first floor, but I really wanted the second floor because the tenants there were trash, as Joel saw during the inspection.
Trash.
But because the first floor had that leak and they didn't say anything and the property got damaged, the seller wants to kick out the first floor instead. But now they're saying that the second floor is also leaving because they bought a house. So hopefully I get 2 units vacant at closing, but we'll see how it actually goes down. And sorry, real quick, the reason why I think that this stuff, like these types of conversations are important, because we're going to be talking about like all these different things, and I don't want to make it seem like making these like financial decisions and investment decisions is just all the way sweet 100% of the time. Like, no, you're going to have issues like this, but like it is going to be worth it at the end of the day, which is why you have to push through and face like the resistance I was talking about last episode during my update, I think. But
it feels like the only person who's not struggling is Eli. I feel like Eli had just went through it kind of easy. I didn't hear his like whole story,
he's struggling a little bit, like when it came to like doing certain work to the property and all that.
Yeah.
But we can talk about that.
I mean, yeah, you're going to see those struggles in a little bit, too. All right, but for my updates, though, so I didn't mention what I was doing last time because I didn't want to get into it too much, but basically what I'm trying to do is a thing called rental arbitrage, which is where you take a property, you put it on a listing like Airbnb or Vrbo or Booking.com, and then you just make income from that through people coming in and booking your property. There's a bunch of different ways you can do this. You can kind of tailor towards people who are trying to go vacation, people who want corporate rentals, people who are just visiting because they're visiting their family or whatever. So you can design your kind of unit how you want to design it, but you need that startup cost of about $7,000 to $10,000 to really get into it. I want to start something called co-hosting, which is where you take a property on Airbnb that's already there, and I was just focused on Airbnb because that's like one of the biggest ones so far. You take a property on this site, you basically manage it for that person. They give you a percentage of all the revenue that comes in. It's a good business model. I've done research on it extensively in my area in Rhode Island. There's a lot of promise for Rhode Island. The problem is it's very hard to reach out to these hosts because Airbnb doesn't like for people to just reach out to people randomly. And I actually tried to, as annoying as it probably was for the people, tried to reach out to them, and my account got blocked. So I made another account. That account got blocked too, or locked. It got locked. So hopefully, I'm still waiting for a response from them. Have not responded to me.
I'm hopeful, yes I am hopeful for today. Take this music and use it.
On why my account's blocked. So I got to see what's going on there and figure that out. But it's making me really think that it might be a good idea. I kind of asked for some help from some of the communities I'm in. And it might be a good idea if I just try to start rental arbitrage first with the first property, build a name for myself. I just have to convince that first person to let me do whatever in their property, let them assure them that they're going to get their rent. That's all they really want is their rent. And then I do whatever with the property. That way I have more control too. I'll feel much more in control of the property, and it'll all be coming out of my own pocket, so I don't have to feel like the pressure of messing up someone else's money. But that's where I'm going right now. If that's the case, though, I have to build that $7,000 to $10,000 of starting up cost, and that usually just includes the rent, the furniture for the first month, and then I try to sign a month-to-month lease, just so I wouldn't be signed into anything long term, and then kind of screw myself over. So because of doing to raise the capital, basically just doing Grubhub, I'm doing some graduation pics because I'm also a photographer on the side too, getting some money there. Anything, because I have about 20 days until I start my other job working on campus as an orientation leader, and then another job too as an internship after that. So I'll definitely be able to raise the money before the end of the summer. It's just when can I really start to implement this stuff. And the timeline I'm looking at right now is if I could find the first property by June 30th, when I'm out of orientation, I have more time to myself because the internship I have is remote, then I'd really be able to get things off the ground still during the summer season, almost into the peak summer season, June and July, or July and August. So that's what I'm currently working on right now. It's a struggle. It's annoying to try to get around this stuff, but this is what I'm working on. I'll keep you guys updated next week on the progress I've made so far, but it's just going to be capital building right now, so I'm probably just going to tell you I've been working, or I'll just come up with another update as well. But that's what I have for that, and that ends my updates for this week.
Word.
So onto the topic of today's episode. We're going to be talking about investing and basically why you should be investing, the benefits of it, why it's not as hard as you think it is, kind of clearing up some of the myths behind it, because some people think you're just going to lose money in the stock market, which is not true. And no, you have anything to say just to start off? Because it's really, I've been telling Noah, this is his, it's not his bag, but when I came into the investment group, I was learning about the stock market, but he gave me a bunch of resources that really helped out, and one of them I'm actually going to see for the first time. So if you're watching this podcast on YouTube, keep watching it. If you're listening to the audio version, you might want to hop on to our YouTube, because we're actually going to be showing you some stuff in a little bit, but I'm going to give it to Noah.
Yes, sir. You said you're going to let me cook? Okay.
I'm going to let you cook for a little bit. I'm going to come in, of course.
All right, bet. Word. Dang, should I be sharing my screen now?
Nah, we can go. I think we should go over
the why.
The why first. Yeah. And I can talk a little bit about that too.
Word.
So the why is when I first got started in the stock market, people of course are going to be doubting you, telling you come on, I've seen people lose a lot of money in the stock market. That's a big thing. People think that a lot of You're going to put money in something you don't really understand, and that money's going to be lost. It's not the case. The stock market it's been around for a very long time. That doesn't mean that it's secure, like it provides security, but it does mean that it's not something that just like sprung up out of nowhere yesterday. It's been there. You can track. There is like analytical data you can track to see how a stock is performing, how companies performing, and then use that information to determine which stocks you should invest in. There's a lot of technical stuff to it, but there are stocks for long-term investors that are very easy to get into and kind of just forget about. So the lane me and Noah take is long-term investing. So we don't really care about what the stock market's doing today because we care about what it's doing 20, 30 years from now. And the reason that helps us is because we don't have to focus on the everyday market. We can focus on trying to build money to put into the stock market so it can build over time. And that's due to a thing called compound interest, which kind of makes your money snowball and make more money for you as time goes on. So it seems a little bit scary, and what I kind of encourage people who are starting out to do is put like $10 in, because now you can buy fractional shares. So you can put $1 in and just look at it for a little bit. This is what I did with my own mom. I told her, just put some money in, watch it a little bit, and if you feel comfortable, put a little bit more in, or put it on an automatic schedule and have it put more money in continuously. Like it could be $20. If you feel comfortable, 100, 120. That money probably won't even affect your day-to-day life, to be honest, and it will still be growing as you go on. This is especially good for people who are younger, 20s range, because you have so much more time for it to grow. And that's something else we can show too on the compound interest calculator, Noah. But there's time right now is your biggest asset because compound interesting is so powerful. But yeah, it's a great thing to start. It's very safe if you invest in the right companies, which will tell you what to invest in. Really, it's not very hard. Short-term investing, though, that's probably where you see people losing a lot of money, especially since like you need a lot of education to know what you're doing when you're short-term selling. Short-term, what is it called? Day trading. Day trading is definitely like a harder thing to get into. It's going to take a lot more education, a lot more preparation, experience. That's where you probably see people losing money, people trying to get, greedy with their stuff. And it's very emotionally based, which is what you want to stay away from. You never want your emotions to guide what you want. So the method that, again, just a summary of why you should do it. It's very safe. You're going long term, so you're not going to have to worry about it. And it's not going to be emotionally driven, so you leave your money there. You don't even have to check your account for 10 months if you don't want to, because it doesn't matter what the market says today. It matters what it says in a few years, 20 years, 30 years.
Can you also speak on real quick, like essentially why cash is trash, like because of inflation and all that? And then if you want to name like
that's such
a couple of brokerages that you use
that's such a big one. Yeah, I cannot believe I forgot that one. Yeah, cash is garbage. If you're holding money right now, cash is absolutely trash.
Big trash.
If you're holding right now, like a lot of people think that holding their money in their savings account is good. No, it's not, because of a thing called inflation. So your standard bank, at least my bank, gives me, I think, a 0.01% return on my investment for any money I put into it. So that's basically completely right. It's pennies they're giving me. I think the biggest one I had was like 3 cents they gave me. And I put a lot of that money into the stock market, so I didn't even give it a chance to grow. But the U.S. dollar basically loses value every single year at a rate of about 2 to 3%. So if you could buy something with $1 this year, you need, I think it's like $1.02 or something like that next year. That might not sound like a big deal, but it adds up significantly over time. If you're holding a bunch of cash in your hands, over time, the value of the cash is actually going to lose value over time.
Yeah,
if you're not putting it
into power, you know what I mean? Like obviously you're going to see the same dollar amount, but you're not going to be able to buy as much with it.
Exactly, because the price of all these goods and services are going to go up with the price of inflation. So what counteracts that is putting your money somewhere where you can actually see returns of equal or more to the price of inflation. That's the stock market. So you're probably seeing, if you invest in the companies that we're going to be talking about, a return of at least, 8 to 12%. I guess that's like kind of modest. And you're going to see numbers that are higher than that because of COVID and its impact. But honestly, I think every single number is going to be higher than 10%. But you usually see a 10% return. That's usually what the market returns at, and that's obviously higher than the 2 or 3% for inflation. So you can expect your money to actually be building wealth over time, building value over time, purchasing power rather than losing it if you just held it in your hands. You never want to just have your cash sitting there because it will lose value over time.
Facts. Yeah. For the S&P 500 specifically, like that ETF, I would say just to be safe, I'll give the range 7 to 10. But as you're gonna see later, like the past 10 years, it's
It just
destroyed
doesn't
that.
matter. That's what I'm saying. Like that's why
Yeah.
I feel like that's such a conservative number because every number is not. It's higher than like 15%. It's ridiculous. Or
Yeah,
14%.
the past 10 years, but just to be safe, you know what I mean?
Yeah.
I feel like it's
Still better
to,
than your 2 to 3%.
That's a fact.
Yeah. And now if you
100%.
invest on BlockFi, you get like 8% if you just hold their stable coins. Insane. I don't want to get into that at all.
Yeah, that's a conversation for another day. But I'm gonna be excited for that one. But yeah, also if you just want to give like a couple brokerages that people could use, especially when it comes to fractional shares.
Yeah, so one I recommend mostly is one that Noah actually put me onto. M1 Finance is great for long-term investing because they only allow you to trade 2 times a day, which means you can't go crazy in emotion. You can't like be really emotion-driven because they only give you 2 times you can start trading at. Also, you can automatically invest in there too, so you don't have to touch your money. You can just put your money in it, and it will invest into your. They call it a pie, but it's like a group of companies that you set a percentage for how much percentage of like this pie you want one stock to be. So let's say we're talking about this S&P 500 company. You can make that 50%. Then you can make another company 50%. If you put $100 in, $50 will go into each share of that stock, each stock basically. And it's very cool because again you can there's fractional shares, so you don't have to buy a total share. Like if a stock price is $300, you can buy $1 of it, and you're still going to see the same returns just on that dollar rather than the entire value of that stock. So I like M1 Finance. I think it's the best one because it doesn't even give you the chance to try to day trade. It's great because it's long-term building instead of short-term, and it just makes more sense if you don't want to actually lose money. Next one I have is Robinhood. They've been on the news a lot because they've been a little bit sketchy, but I don't think it's a bad option. It's very easy to use. I've used it before too, but I actually switched from Robinhood over to M1 Finance. And you can do the same things you can do. In fact, you can invest in cryptocurrency over there too, which is, again, another thing. But there's a lot of options you can do over there. If you want to try to start day trading, if you want to try to do that stuff, you can also do that there. I just only recommend that if you're actually willing to put in the effort to try to learn how to do that. And then I guess I'll recommend Webull as well. It's just another version. It's just like the same exact thing. It's very similar to Robinhood.
Can you
I think
do
it's a little
fractional
bit more
shares at
complicated
Webull
to
though?
use. Yeah, I think you can.
Okay.
I think you can do fractional shares on everything now. Well, at least the mainstream ones. M1, Webull. I recommend those. Personally, I don't know if you have any. I know you don't. I know you have another. You have your E-Trade, but
Oh, I have accounts at like basically everywhere.
like everything.
Yeah, like every brokerage. Just because sometimes like certain ones they offer certain benefits or whatever. So I might as well just have it anywhere. Or in case one is acting up, I can also just move my money to another
Yeah,
one
like Robinhood.
easily.
Literally. Yeah.
Yeah.
That's why I'm trying to get my Robinhood because they have to deactivate my account after the transfer, which I was like, that's so
Dang.
annoying. Yeah.
Yeah, I was gonna say M1 though. I feel like we gotta put out like the disclosure, whatever. Like it is very specifically only for long term. Like,
Yes.
You cannot be trying to do any kind of short term moves with M1. So I personally hold all my really really long term stuff at M1 because I'm not gonna be trying to just get in and out of trades, or put in like stop losses and limits and all that stuff. That's not what that brokerage is for. So just keep that in mind. And the thing about not losing money. So when we're talking about not losing money, we're specifically talking about when you're investing in like certain types of ETFs, which are basically index funds, but these are just the ETF versions of those funds. But basically an index fund.
Oh, version.
Versions.
I said version. Yeah.
Maybe I did. My fault. But
No, that's funny. All right.
yeah. So essentially, an index fund is a fund that's tracking like a specific index. So the ones we're going to be talking about today is the S&P 500, which we spoke about before, but essentially that's the largest 500 companies in the United States, and also the NASDAQ, which is the technology index. So all like the tech companies or whatever. So if you believe that essentially technology companies are going to be the wave in the future, then even though you might see like a paper loss like on your screen at some random points in time, like for example last March when everything crashed in 2020, yeah, like you might in your head be like, oh, I lost money, but you didn't technically lose money until you actually sell. When you have a short-term mindset, you might feel like, oh wow, like I actually did lose money. And I'm not telling you like this is how you should invest necessarily, so that's why I'm also going to point you towards certain books like where I got my knowledge from in a second. But yeah, when you have a long-term mindset and you really believe that this index, and you can actually look at the companies in the index as well to see like what am I actually invested in. And the thing with the S&P 500 specifically is it's always going to be the largest 500 companies. So if certain companies start slacking, they're getting kicked out. And the people that are doing better than them are going to move their way up on the list. So it's always kind of like almost,
they don't play.
Like a self-cleansing system in a way. Because it's always going to be the best of the best that's there. And these are companies that are like already established and everything. So you're essentially good if you're really like, I'm truly holding this for the long term. But there are going to be years where you're down. Like, for example, 2018, we ended up like negative. I forgot the percentage, so I'm not even going to say it. But I know I was down on that. And I had started investing in, what was it, 2017, I think. So it's like 2017, I think, was a good year. But then I started having like more money invested in 2018. So I was at a loss for a little bit. But understanding the nature of the game, and because I actually had the conviction, because I was continuously educating myself, and that's what we were talking about in the first episode, being in the gym always, so you have that conviction and you know, like, for example, if I thought that this ETF is going to continue rising in the long term, then I should actually be happy if I'm getting to buy it at a lower like dollar amount. You know what I mean? Like now I'm basically getting a sale. So the same way that you're looking for certain sales like Black Friday sales, or I don't know, some of y'all be shopping on the clearance rack and all that. No disrespect, no disrespect. That's not hate. But yeah, so if you like buying things at a discount, then why are you mad at buying investments that are actually going to work for you in the long run at a discount? That makes no sense.
I feel like it all goes back to education too, Noah.
Yeah.
Because if you know for a fact it's about to go up, then you wouldn't even be scared. That's why when this whole little correction happened, I was souped.
Yes, sir.
I was putting as much money as I possibly could into that. I guess I'm going to say a little quick thing too about margin. I would recommend not going on margin. Mostly because there's it's like you got to think you're gonna have to pay that loan back, and you're gonna have to pay back interest. So you might think you're seeing crazy returns, but they're probably gonna eat up your returns straight up, and then you're gonna have to you're gonna be left with a profit potentially, but really not as profitable as you think. You think there's ever a good time to take out margin though?
I think that there is, but I've never done it. Yeah, I've never done it, and I'm just not really that interested in doing it, to be honest. So,
and I guess if you think about it, like, what reason would you really need a lot of money to be? Unless it was like the market crash that just happened, and you like know it's gonna come back. You're like, all right, I'm gonna take out some money and put it into this, but can't really see another situation where you do that.
So if you're actually a really knowledgeable trader, then there are certain ways to do it responsibly, and you're using like your risk management tools and all that, then you can use it, and that's fine. But for like a regular person, like you're not really studying this all day every day, then you have no business using it, I feel like. So yeah, I would stay away from it unless you truly know what you're doing. And what was the other thing I was gonna say? I think it was, oh yeah, it was. I just want to I really want to emphasize the point about like having your conviction behind it, because if I'm just saying like these are funds that I use and like these are the reasons why, and you just go and do it, and then you have a bad year, like the S&P is down 1 year, you're probably gonna be wilding because you don't know, like you don't really feel like it's gonna come back because you're just going off what I said instead of finding the information yourself, which is what I did, which is why I'm confident about what I do. But Some of the books that I use to gather that knowledge base was, and I talked about it before, what is it? Money Master the Game by Tony Robbins. He also has another book called Unshakable, which I think it's kind of like the way more condensed version of Money Master the Game, because Money Master the Game is extremely long, probably unnecessarily, to be honest. Another one is The Simple Path to Wealth by J.L. Collins. And then if you want to get into investing in individual stocks, which I did in 2020, and I'm just going to hold what I have, but I'm not really sure if I'm going to continue to add to individual stocks aggressively unless I just see like a really, really great opportunity. And you talked about it during your interview, Joel, about 2020. It was just like you could basically buy anything and it's going to run up.
Yeah.
Yeah, so if you're actually buying great companies, that was kind of like the cheat code. You could just finesse your way in. So I'm up crazy on certain companies, but I was using the cheat code. So,
bro, I feel like though with the individual stocks, I've had my like little conviction about two companies, Carvana and Airbnb.
I love
and I was just
companies.
So do I. And I was looking at Carvana. I was like, this makes so much sense. So I bought that like way back. And then Airbnb I actually held on to, but I kind of sold both of those companies for the S&P 500 because, like you were saying, my conviction wasn't that strong where I was like, this makes more sense than the S&P right now. So, and I don't have that much capital to be putting in that it really matters. I prefer to put it into that long-term bag.
Makes sense. But yeah, so if you want to get into individual stocks though, you could also use, there's a book called Invested by Phil and Danielle Towns. They also have a podcast if y'all want to check that out. And then also you could check out Wall Street Trapper. He has a course. I think it's called like the Wall Street Trapper course. But yeah, that you can get a lot of education on how to invest in individual stocks through their platforms. So I would check them out. But today we're just gonna be talking about index funds. So we getting into it?
Yeah, we should share the screen.
Yes, sir. Okay. A way that you could look up different ETFs. So ETF stands for Exchange Traded Fund. You can look them up on ETF.com, which I have up right here. So you would type in the ticker symbol that you're looking for, whichever it is. So VOO, for example, is Vanguard's S&P 500 ETF. So an ETF differs from an individual stock because an ETF is more like you're investing in a basket of stocks. Like it's a lot more diversified versus you just having a singular position like one specific stock. Because with the index, like for example the S&P 500, if just one company is doing bad, you might have like the other 499 companies might be doing well. So you're not really taking as big of a hit versus if you are investing in like an individual stock and that's all you have and that's dropping crazy. Hey bro, I don't know what to tell you. Hopefully it's a great company. You might want to get in on that sale. But if it's trash, hey bro.
And I think the trade-off for that is really, these follow the market. S&P 500 for the most part follows the market. You're not going to see like crazy returns like you'd see if you invest in individual. Like if you invest in Apple back in the day, you'd probably see a crazier return than if you saw in the S&P. But you get the security from investing in an index fund.
Yeah, exactly. And by the way, if y'all ever want to like figure out different ETFs to invest in, you could also just go on Google and be like ETFs that invest in whatever you're looking for. So like ETFs that invest in, let's say, what is it called?
Cannabis.
Like electronic vehicles or whatever. Like you can just type that in on Google and go get the ticker symbol and put it in on ETF.com and find the majority of the information that you're going to be looking for. So something that I like to do when I'm looking at whether it's a stock or a fund, I definitely want to see their 5-year chart to see how they've been holding up during that time period. So if it's not looking like this or anything close to this, you can see it on the screen, right, Joel?
Yeah.
Like if you're not seeing a good upward trend during that time period, it might not even be worth your time to even do a whole deep dive on whatever it is that you're trying to invest in. I really like to look at, for example, the 10-year annualized return. And like we said before, like the benchmark is essentially the S&P 500. So if it's not going to give you at least 7 to 10%, on like an
Not
annual
worth it.
basis. Yeah, it's probably not even worth your time, to be honest. So, yeah, for example, VOO specifically has done 14.23% over the last 10 years annually. So that's way more than the 7 to 10% that we talked about before. But keep in mind, it ran up crazy in 2020 though. So
Yeah, 2020 did have a huge impact on. That's what kind of messes me up when analyzing the data. If anyone, oh, can you go back up to that? You see that 1 year? The 1 year is 47%. That's insane. Oh no. I mean, we could pause it.
okay, I want to see if I can see like the companies. Okay, perfect. So you can also look at the top 10 holdings on here as well. So if you keep scrolling down, it will see, for example, VOO top 10 holdings, and it gives you the option to view all. But as you can see, like the top 10 is Apple, Microsoft, Amazon, Facebook. Google has 2 symbols. I don't know why.
Yeah, I don't know
Tesla's
why
in there,
either.
so you're getting Tesla exposure. Berkshire Hathaway, J.P. Morgan Chase, and Johnson & Johnson. And you should all be familiar with basically all of these companies. So Alphabet, by the way, that's Google. So yeah, and these take up like 26.24% of the S&P by itself. So these are the big boys. And if you wanted to get into individual stocks, another way you could do it is by looking at, for example, ETFs like VOO and going by like their top 10 or top 5 holdings. So when there's a market crash or whatever, those would be more so my kind of go-tos, because you kind of know that they're already established and they have to be pretty good businesses to even be on this list regardless. So if you want to kind of have a safer play, I would kind of recommend that. And then the next, let me see. Sorry. The next
That's what I
ETF,
keep it too.
You said what?
I do that same thing too. Like, well, not really the same thing, but I invest in VOO and then I invest in some of the top companies too.
Yeah,
Just
so
to see
that's
what's
always a
legit.
wave too, because you're kind of just doubling down on that conviction. Like, I know that they're going to be there. And you can check up on them as well. So, like, if you want to do it, like, every quarter or semi-annually or whatever, or even just annually, you could check to see, are these companies still in the top 10? Because if they're not, hey, bro, you might have to leave my portfolio.
Switch them out. Yeah.
Yes, sir. So this is VGT, which is essentially tracking basically the NASDAQ or the technology index. So the past 10 years, VGT has actually done 20.77%.
Insane.
Yeah, that's crazy. Especially once we get to the compound interest calculator, you're going to see how much of a difference that makes year over year. So, yeah, if you believe that like technology companies are going to continue to like innovate and just be extremely profitable like in the future, then VGT might be a good play for you. Also, keep in mind that you're going to find, as you're like expanding your knowledge, that a lot of these ticker symbols, like, it doesn't even really matter. Like, there's going to be a bunch of ETFs that are just like VGT that track the NASDAQ. Like, you can use, for example, QQQ, you can use XOK. They're basically all kind of similar, so it really doesn't matter. You don't have to get hung up on that. But yeah, another one I'm going to look at. So this one isn't an index fund. It's not tracking a specific index. But this is... I was going to say that chart was looking trash, boy. That was not it right there. But this is ARKK, which is basically... This is actually an actively managed ETF. So that means that people are actually like doing trades actively within this fund. But it's managed by Kathy Wood from ARK Invest. So they have quite a few different funds. Yes, sir. So this is just their flagship fund, like their kind of most promoted. But yeah. So, sorry. Actually, let me go back to VGT real quick just to go over their top 10 holdings. But some of them are going to be pretty similar. Like, for example, Apple, Microsoft. They also have Visa, Nvidia, MasterCard, PayPal, Intel, Adobe, Cisco, and Salesforce. So y'all might not know all of them, but you're probably familiar with the majority of them.
Notice how the top 10 holdings is 56%.
Yes, sir. That's crazy.
How many? Do you know how many are in this ETF? How many companies are in this ETF?
I'm trying to see if it will.
Yeah, they don't even give you a little quick
Yeah, I'm not gonna count
There's
that.
a lot. Yeah, there's a lot.
But you can also go on the Vanguard website and look it up if you really want to know. But Apple and
Yeah.
Microsoft by themselves hold up huge percentages in this. So Apple is 19.68% and Microsoft is 16.05%. So yeah, I mean,
I didn't even mention it, Noah. Why?
What up?
So why? I'm gonna ask you then. Why do we use Vanguard's ETFs and index funds? Why don't we use like Fidelity's or like the iShares? Like why do we use Vanguard in particular?
so this is what I was saying before. Like, it really doesn't matter. Like, most of these brokerages, like the bigger players in the game, like they have funds that are essentially like the same thing. So you can use whatever. The only reason people that are kind of been in the game for a while use Vanguard specifically is because I think Vanguard was the first, or at least one of the first brokerages to give people I think to even put out index funds actually.
Yeah, they got
So I
the
think
first blue
that's
check.
why. And they did it for like a very, very low fee. So I know I saw it somewhere on here. The expense ratio.
It's like 0.0.
So VGT is a little bit more
Sure.
expensive. This is 0.1%. And VOO, I think it's like
0.02.
0.0.
I'm gonna guess.
I thought it was 0.03. Yeah.
Yeah, you might be right there. Yeah,
0.03.
0.03. That's tough.
Yeah. So basically the expense ratio is kind of like they want to make sure they're kind of taking their cut too. So that's why most people go with passively managed funds, because when it's passively managed, like there's not someone there like making trades and constantly trying to analyze new stocks to beat the market or whatever. Like they're going to want to get paid more because they're doing a lot more work. So ARK, for example, let's go to there. So yeah, her expense ratio is
Dang,
0.0.
0.75?
Sorry, yeah, 0.75%. But keep in mind, and it's not to say that this fund is going to keep doing this. So this fund hasn't been around for 10 years, so you're not going to get the 10-year annualized return. But the past 5 years, it's been 47.27%. So it might be worth it for some people to consider investing in a fund like that, because yeah, she's taking a higher cut, but those 5 years, she significantly outperformed the market. So just to go back real quick, the 5-year return for ARKK is 47.27%. For VGT, to give like the fair comparison, 30.87%. And VOO, the 5-year is, where is it? Dang, I knew I was mad close to the bottom actually. Pause. But yeah, the past 3 years it's been 18.38%.
Oh, you mean 5 years? You mean 5 years?
Oh yeah, my
I think
fault.
you're-
5
yeah.
years, yeah, sorry, 17.08%. So I mean, Kathy murdered the market. But I will
I have
say
another
that.
question for you though, Noah.
Go ahead.
Nah, you can say what you're about to say. Just I have like something I have to ask.
Yeah, so I would say keep in mind too that, like, I'm not necessarily gonna say that I believe she's gonna consistently do that forever, and a lot of her, I don't even think her portfolio was really, or her fund was really doing that great until 2020 specifically, because we all know, for example, companies like Tesla ran up crazy in 2020. So if we go through her top 10 holdings right now, it's Tesla, Teladoc, Square, Roku, Zillow, Zoom. We know Zoom went crazy. A lot of these companies went crazy, but we know Zoom went crazy too. Shopify, Spotify, what is that? Baidu. I don't even know that company. And Exact Sciences Corporation. But yeah, so
Yeah, the question I had about you then is like, can you really look at these returns in light of like the COVID pandemic? Can you?
well,
like,
you can
really
see it on the chart too. So
before
y'all that are watching this on YouTube, first of all, you better like and subscribe.
Yeah, facts.
Second of
There
all, you better
go.
leave a comment. We gonna respond. You know what I mean? But yeah, you can clearly see 2020 was their prime. Like they destroyed it. If you're looking
Yeah.
at this chart, so, and for y'all that want to see the chart, you can go on ETF.com. There's many places you can go, but you can look specifically at ETF.com if you want to see that chart, to see what we're actually talking about right now. But yeah, did you have another question or no?
No.
Okay. You guys can also back test a portfolio, which that basically means it's going to be looking at like past data to essentially let you know if you had invested in, for example, these specific ETFs or these specific stocks or whatever the case is, like what would your return have been over a certain time period. So what I use for that is portfoliovisualizer.com, and I hit like backtest portfolio asset allocation. I always benchmark it against the Vanguard 500 index. So that's essentially VOO, to be honest. But yeah, because if it's not gonna outperform the S&P 500, why would I even go out of my way to do anything extra? Like it doesn't make any sense. You know what I mean? And you can play with the initial amount if you want to. I typically just keep it at 10,000 because I'm more so looking at like the percentage rate of the return more than I am like the specific dollar amount that's being invested. But in this specific example, we'll go through if you had invested in VOO and VGT and you did a 50-50 split between them, which I'm not necessarily recommending that you guys do this. I'm just saying this is something that you can do and just to show an example. So this is essentially the S&P 500 by itself versus a 50-50 split between VOO and VGT. So you would just hit analyze portfolios and it's going to show you. So if you had just invested in the S&P 500, actually, matter of fact, let me do the dates. So starting from
facts.
Yeah, so starting from it's actually starting from
Yeah,
January
I just noticed that
2011.
too.
Yep. So January of 2011 up until April of 2021, because the ticker symbol for VOO only came out in October of 2010. So to keep it fair, this is essentially 11 years of data. So if you had just invested in the S&P 500 by itself, then you would have got a 14.48% return. If you did the 50-50 split between VOO and VGT, you would have gotten a 17.64%. And if y'all want to know how that actually affects in terms of dollar amount, so with just the S&P by itself, if you had put in 10 grand at the beginning, then you would have ended with $40,457. Whereas if you had put that 50-50 split between VOO and VGT, then you would have ended up with $53,591. You're also going to see like a chart here as well for the growth. So you see that they were kind of following each other for the most part up until basically 2017. Oh, cool. Yeah. So it's also going to show you like the 3-month year-to-date return, 1 year, 3 year, 5 year, all that. So yeah, you actually get a lot of data from this website. So I like it. And if you guys are wondering why, for example, you would even do a split, because we already went through, like, on ETF.com, like, we already know that, for example, VGT destroyed VOO within the past 10 years, but sometimes, like, people want to be a little bit more diversified, because what if, like, tech really isn't going to be it in the future? Or what if it's really just having like a really great wave right now, but you don't know if it's always going to be like that, like decades down the line, like other types of companies and stuff might catch up. So that's kind of why you would split it between VOO and VGT. And I would also say this too, and this kind of leads more in the next part actually. So yeah, actually let me leave that out for right now. But something else that you guys can use, a tool, is a compound interest calculator. The one I have up on the screen for y'all that can't see the video, it's the one from moneychimp.com, but you can literally just go on Google and type in compound interest calculator. They basically all work the same.
I do like this one though, Noah. I always use this one.
Yeah, me too.
Something about it, I don't know what it is.
Yeah.
Someone like try to do some extra stuff. Like you just need some basic numbers. But
Yeah, you don't need nothing crazy. But yeah, so you can play with it. So for example, if you're not starting out with any dollar amount, right? So you can leave that blank or put 0 in there. But you can do, for example, your annual addition. Like how much do you think that you can contribute on an annual basis to investing? Can you pull out your calculator real quick,
Yeah.
like on your phone? And
I gotta
so
feel it.
what's like a decent a dollar amount or a decent dollar amount that you think people can invest? You want to say like let's say
It really
$25
depends on
a
your
week.
income.
But I'm saying
$25
something
a
light
week.
for like college kids or whatever,
Yeah.
like just starting out. So let's
I
say
guess we could start with
$25, right?
Yeah. Yeah.
There's basically like 52 weeks in a year.
52. So 1,300 a year.
So 1,300 a year. So, and let's say you're starting out at the age of 20, right? So if you just wanted to set yourself up for retirement in the long run, like to retire at 65. So
That's
we'll
disgusting.
put 45 years to grow. And for interest rate, let's put 10% for right now. So when you calculate that, yeah, so if you had started off at 20 years old only putting $25 a week for 45 years at that interest rate of 10% annually, then you would end up with $1,028,033.92. So, as you can
That's
see,
insane.
when you start,
That's insane. I
Yeah,
think we need
when
to,
you start-
clarify that. That's insane. That's $25 a week, bro. That's like a meal a week.
yeah.
At a
So you
restaurant.
can see when you start really early, becoming a millionaire is really not that difficult at all. It's just that most people don't have the knowledge, so they're not really gonna understand that. And then also, just to show the importance of time. So let's say you started at 30 instead of 20. So you took 10 years off. You would only end up $387,564.85. So
Yup.
what was that, like damn near $700,000 difference
Yeah, gone
in 10 years. So that's why you
Insane.
want to start investing as early as possible. But the reason go ahead.
I was gonna say, can you show them what it would have been? I'm curious what it would have been if you invested in VGT with that 20% interest rate for 10 years, just to see what it would have been.
For 10 years?
Yeah, let's say you started out with let's say you just kept adding on like the same 25, 10 years. Yeah.
Okay. So $25 a week would have turned into $40,495.54.
Yeah, I guess I have no sense of like what that really is, but for some reason to me that seems a little bit low. But that's just a compounding too.
Well, that's 10 years, so let's see.
Yeah, that's true. Yeah, like 20 years would already be.
Actually, I'll play nice. So I'll say 15%. So if you want to do, for example, a split between VOO and VGT, and you believe that you can get 15%, right? And then we'll put the original time frame. So if you want to retire at 65, that's $5,359,767.05, bro. 5 cents.
$25 a week and 5 cents. Yeah, $25 a week. This is why when I calculated my thing out, I said I needed $28. I was like, I'm sick because that's nothing. $28 a week is not that much money. You can make that doing like 2 DoorDash orders or Grubhub orders actually, and that's incredible.
Yeah. So this is why you want to start investing as early as possible. But another point that I really want to make is also that for people that want to be, for example, entrepreneurs or getting to other types of investing, like when you read books like Rich Dad Poor Dad, he had mentioned specifically that the reason that he's able to take so much more risk in all these other areas is because he already had a solid foundation. So, for example, if you're starting at 20, and you can play with the numbers how you want to, maybe we could even leave like these websites in the description or something.
Yeah.
So
I'll
y'all
leave
can
in the
see
show
it.
notes and description.
Because maybe you're not 20, maybe you're 25 or you're 30 or whatever. So you can figure out, all right, cool, how much would I need to put up a year at this expected interest rate to get to $1 million or $2 million or whatever your number is. But I'm saying if you're starting out at the age of 20 and you're putting up $25 a week and you have that strong foundation, so you already know, all right, worst case scenario, like even though I didn't want to wait until 65 to retire, I know that if everything else I do fails, as long as I keep contributing this $25 a week, then I'm good. Like I can take as much risk as I want. If you want to invest in individual stocks outside of that, go ahead and do that. If you want to go start businesses and all that, go ahead and do that. You can do whatever you want because you already have that strong foundation. So if everything else fails, you still can rely on this.
So Noah, what would you
Yep.
do then if you had like why is it that you want to get to a million? Why do you even want to get to that $1 million? Is it are you gonna just draw the money out when you get to a million and use it?
I mean, I don't know why you talking to me like that, because $1 million is not enough for me.
Facts.
That's chump change, my boy. I'm
Facts.
gonna have $1 million like probably within the next couple of years. That's the goal.
Yeah, I mean
By
like you as
30.
in like our audience. Like why would they want to set a
Oh.
goal for a million? Like why'd you tell me to like calculate it up to a million? Like why is that? Why is that the number?
The only reason I say that is because a lot of people want to become a millionaire.
It's
And
just
they
a
think
millionaire,
it's so,
yeah.
Yeah, they think it's like so crazy, which I understand why they think that, because before I started learning about this type of stuff, I thought that as well. But now I'm like, I mean, it's what Lil Baby said. Like, I ain't got 100 million. I can't chill yet. So, and it's not to say I'm really going for 100 mil, because to me, like, the actual dollar amount is actually irrelevant. Like, what I care about is actually just like the time freedom. Like, I want to know that I can spend my time however I want to, and I don't really have to do anything for money and be a slave to money. Like, I can just do what I want to do because maybe like I just feel like this is the right thing to do. So
I want to
Yeah.
say too for on my side then that a big part of what I want to do is I want to get more than 1 million. I don't know if that's going to happen, but what's going to happen though with that is you can actually take some money out of your portfolio and use it for yourself. Something called the 3% rule or 4% rule, whatever percentage you want, as long as it's under, I think it's under 10%, it won't completely deplete your assets. I'm gonna have to make another edit for that mess up of my vocabulary. Anyways, so if you get to 10 million, the kind of way they say it is that, or 1 million, you can take out 3% of your portfolio, and it's not going to affect anything related to your portfolio. So if you have $1 million, you can take out 30,000 and use it, and your portfolio is just going to grow as normal. So you don't have to worry about anything with that. And then you just have an extra $30,000 you can use. And if you can survive off $30,000, then you're technically retired. That's where you want to be at, or at least that's where I want to be at, because then I can do whatever I want without feeling like I'm a slave to money, like Noah was saying. I can really put all the time and effort into things that I actually want to do. And that's becoming financially free. That's what we're all striving to get to.
yeah, so there's like the 3% rule. I think the more kind of like famous one is like the 4% rule. So it's
Yeah,
basically
the
just
only reason I
bumping
said
up another
3%.
1%.
Yeah, the only reason I said that was because I watched, I don't even know, I just watched this video of this YouTuber, and he was like, I'm going to keep it at 3% because I'll really be conservative with that number, so it really won't deplete. But 4% rule is really what it actually is called, yeah.
Yeah, so I was gonna say too, it's basically like your portfolio is just growing so much faster than you're actually spending the money. So, like for example, on $1 million, if you're getting a 10% return, what is that, like 100K, right?
Yeah.
Yeah, but you're only taking out, if it's 4%, then 40,000.
40,000.
So there's still a big spread there. So
Mm-hmm.
your money is growing faster than you're actually spending it. So yeah,
And-
I mean it's a little bit more complicated than that, but that's where it comes in. Like y'all got to do your own research as well. But yeah, so it's definitely a good rule to go by. And there are some people that, like, essentially their goal is just to pile money into these types of funds like VOO and VGT, for example, like index funds, and they're just gonna retire that way. Like they don't want to go start businesses and stuff like that, and you don't have to in order to become a millionaire. You could just do this and bump it up. Like if you want to do, for example, like $50 a week or $100 a week, and see how long it's gonna take you to retire on your dollar amount that you're looking for. So yeah, I mean that's definitely a way to go as well. Something that I
And
like
the
to
re-
do. You can go if you want.
I was going to say the reason I think you're trying, the reason why this is important is because you can see what you have to do. You can kind of set goals for yourself for each week of what you should be putting in. It's an actual number rather than you saying like I'm going to put in some money this week, no money this week. It's actually like you need to put in this amount to get to this goal. It's more, once you have real numbers in it, I think it becomes easier to track and to reach that goal.
Yeah, so you can even set up automatic transfers like you were talking about at the beginning with M1 Finance. You could probably do it with, I'm pretty sure, like any brokerage. But yeah, you can have it set up to be like automatically take out a certain dollar amount every single week or every month or bi-weekly, however you want to do it, to make sure that you're at least doing this putting like these types of annual additions or weekly additions into your portfolio to make sure that you hit that goal. But what I was going to say was something that I like to do is whenever I start a venture, I'm typically looking more so at the long-term effects, and I want to make sure that I'm creating foundations in like each of these different asset classes. So I'm looking at, all right, so how do I make sure I set myself up for financial independence in the stock market? And then once I feel like I'm at a good place with that, I'm like, all right, cool. So now let me get into real estate and set my foundation there and keep doing that over and over again. And if you don't even want to do it more foundationally in terms of like continuing to kind of like play it safe, I guess, all the time, you can be really aggressive in these other areas. So like I was saying before, for some people that are just really into, like, you really love trading stocks, or you really love the idea of trading stocks, I should probably say, you can still trade stocks if you want to and try to beat that return. And that's fine, but I would still recommend at least making these contributions to like certain index funds. That's just my personal recommendation. So you can do whatever you want, but I would make sure that you have a strong foundation so that you can be aggressive in other areas.
I hope you all stay tuned for the entire thing. This kind of is the biggest part when it comes to your journey, understanding the fundamentals, how you can get financially free through the stock market, understanding it's not a scam, and that there's many tools out to help you as long as you're doing your research yourself, picking the path you want to go on, and then sticking to the schedule that you set for yourself. Thank you again, Noah, because Noah did show a lot of this stuff to me when I was learning, and it definitely helped me understand more about the market and how I should be operating myself. And I hope that this information helps you guys figure out what you really want to do, the path you want to take, and then helps you stay on top of it throughout the entire process. If you did like the podcast, please leave a review, like the video if you're watching our YouTube, and then please subscribe as well. It definitely helps us on the YouTube algorithm. If you made it this far, then you really do like our content. Next week, we're going to be talking about the importance of tracking your spending, why it's important to make sure that every single dollar that comes into your account is being accounted for, and then how that can help you throughout your financial process, as well as give you some tools you can use to actually track this stuff so you don't have to, be spending hours doing it. And it really does not require that much. Oh, no, I ran out of space on my memory card.
Dang.
That's crazy.
I was going to say, it's going to help y'all be able to actually run your life as if you are a business as well. And being able to kind of automate that process.
Yeah, you got to do the outro now that I have no video.
Dang. Wait, hold up. What is there left to say for the outro?
Nothing. Nothing. Just we'll see you next time.
All right, y'all. We'll see you next time. Make sure you like, subscribe, and leave a comment. I'm trying to talk to y'all for real.
Yes, sir.
You know what I mean?
Yes, sir.
All right.
We'll see you on the next episode.